Does the SIPC cover treasuries, boomer candy ETFs, and crypto all in the same manner? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. We've gotten quite a few questions along these lines recently, so let's revisit SIPC coverage and whether it extends to some of the newer investment products that are now being offered on the market. Here are the three topics that we'll be covering in today's video. 1. What does the SIPC cover and by how much? And in this section, we'll be clarifying a few specific points around treasuries, money market funds, structured products like the Boomer Candy and other structured ETFs we've talked about in these recent member videos, as well as cryptocurrency. 2. What if you have multiple accounts with the same brokerage company? And 3. How does excess SIPC coverage work? Let's dive in now, folks. What does the SIPC cover and by how much? So, when we talked about FDIC insurance recently and how you could increase your coverage to as much as $1.25 million with the same bank in certain situations, we were speaking about checking and savings accounts only. I've linked this latest FDIC video in the first pinned comment below for those of you who may be interested. But what about the brokerage accounts that we use to buy, hold, and sell securities, such as stocks and bonds, and also newer products such as structured ETFs and crypto ETFs as well? Well, those are covered by the SIPC, the Securities Investor Protection Corporation, which protects, insures the customers of brokerage firms against some types of losses. The limit of SIPC protection is $500,000, which includes a sublimit of $250,000 for cash. It's important to understand what type of risk the SIPC protects you against, though. The SIPC will not protect you against price decreases or losses in your investments. It does not cover market risk. What the SIPC will do, however, is that it will replace any missing cash and securities, such as stocks and bonds, in the event that your brokerage firm fails. It's really an insurance against your broker losing, or worst case, outright stealing or embezzling your securities. So let's pretend that you have a brokerage account with a make-believe brokerage firm called High Yield Brokerage, and you own 100 shares of To the Moon Bank, also made up in this account. If High Yield Brokerage goes bust and your 100 shares of To the Moon Bank are nowhere to be found, the SIPC would make sure you get 100 shares of To the Moon Bank or the current cash equivalent delivered in your possession, despite the fact that High Yield Brokerage has gone bust. What the SIPC will not do is make you whole for any price decrease or losses in your shares. So, yes, the SIPC will make sure you get your 100 shares of To the Moon Bank. But to take another hypothetical near worst case scenario, if the 100 shares altogether are currently only worth $10, you'll still just get exactly those 100 shares, or $10 as the current equivalent in cash, even if you had paid $1,000 to buy them just a few months ago. Nobody will make you whole for the losses you had to take on your investment. Of course, the principle also works the other way around. If you owned 100 shares of NVIDIA and they happen to be missing from your brokerage account, you'd be thrilled to have SIPC protection. The SIPC will now deliver you those 100 shares of missing NVIDIA stock or whatever they're currently worth in cash, even if you initially only paid $10 for them, and they are now worth $1,000, which is clearly a good thing that will help you sleep better at night. And because we just spoke about either replacing the shares or paying out the current market value, the SIPC will usually first try to replace any missing securities in kind, meaning with the same number of shares of the same securities. Only if the SIPC cannot replace your missing securities will you receive the cash equivalent instead of what those missing securities were actually worth on the date that you filed your SIPC claim. Remember that in most cases, even if your brokerage firm goes bankrupt, those securities that you purchased via your brokerage firm should still be in your brokerage account or held in custody somewhere else with information attached to it that you are the rightful owner. And because you're generally the owner of the securities you buy, those securities should still be in your account, even if your broker were to go out of business. Those securities should really only go missing, even in the case of a bankruptcy, if some type of fraud or some grave mismanagement or operational breakdown happened. Now, here's what SIPC does not cover. 1. The SIPC does not protect against the decline in value of your securities, as I just explained. If you had bought stock in To the Moon Bank for a price that now looks like it was way too high, well, I'm sorry for your loss, but SIPC does not cover that loss in market value. 2. SIPC does not protect you if you're sold worthless stock or other securities. And 3. SIPC does not protect against losses resulting from a broker's bad or inappropriate investment advice to you. And more fundamentally, the SIPC only covers securities. So that we're clear on what the SIPC categorizes as a security, let's go to this What Are Securities section of the SIPC site for a more detailed explanation. SIPC protects stocks, bonds, Treasury securities, certificates of deposit, mutual funds, money market mutual funds, and certain other investments as securities. SIPC does not protect commodity futures contracts unless held in a special portfolio margining account, or foreign exchange trades, or investment contracts such as limited partnerships and fixed annuity contracts that are not registered with the U.S. Securities and Exchange Commission under the Securities Act of 1933. Digital or crypto assets have been issued and are transferred using blockchain or distributed ledger technology. While some of these digital assets may qualify as securities if they're deemed to be investment contracts, an investment contract, digital asset or otherwise, must be registered with the SEC in order to be a security as defined by the Securities Investor Protection Act, SIPC. Digital asset securities that are unregistered investment contracts do not qualify as securities under SIPC and are therefore not protected under SIPC, even if held by an SIPC member brokerage firm. And the easiest way to explain this paragraph is, of course, with an example. Let's say that you hold $100,000 worth of shares in a spot Bitcoin ETF, such as iShares Bitcoin Trust, IBIT, in your account at an SIPC member brokerage like Fidelity. If Fidelity were to go bankrupt and due to mismanagement or theft by the brokerage, your Bitcoin ETF shares are missing from your account, then the SIPC would step in to replace your missing Bitcoin ETF shares up to the $500,000 limit for securities, and you would receive equivalent shares of the ETF or their cash value at the time of the claim. Why? Because the shares of a registered ETF, like in our example, are considered missing securities under SIPC's definition. And SIPC protects against this loss of securities held in a brokerage account due to the firm's financial failure. However, if you held the same $100,000 worth of Bitcoin directly in a crypto account at Fidelity, the SIPC would not protect you because Bitcoin itself is not registered with the SEC, which considers Bitcoin to be a commodity that's outside their world. So it all depends on how you hold your crypto assets. Only if Bitcoin or any other unregistered cryptocurrency is held via an ETF or any other registered vehicle will the SIPC consider it a security and insure you. The definition of what the term security means for the SIPC is clearly important. So here is a more detailed list. Feel free to pause the video here and take a closer look at everything shown. As customary, I've linked this page from the SIPC's website and the other sources referenced in this video in the first pinned comment below for your convenience. And because we get this question a lot, please do note that money market mutual fund shares held in a customer's account at a brokerage firm qualify as securities under the Securities Investor Protection Act, SIPC, and therefore are subject to the $500,000 limit of protection, not the $250,000 limit applicable to cash. It is important to remember that although many investors treat money market funds like cash. They are securities. And the same basic principle of form over substance, so to speak, applies to the new structured ETFs that are currently coming on the market. Many of these structured ETFs hold a lot of derivatives. In some cases, the bulk of their value is in such derivatives, such as in the case of the Calamos Autocallable Income ETF, CAIE, that uses a total return swap, as we recently discussed in these two videos here. Again, link below in the first pinned comment. You as an investor, though, don't need to worry about whether those underlying derivatives would by themselves be considered securities in the eyes of the SIPC. Just like for Bitcoin ETFs or money market funds, the legal form, the packaging, or the wrapper, as the industry calls it, is the only factor that you need to take into account. So if the package of an investment is a security, it's considered insured by the SIPC. And yes, this means that CAIE, the Calamos Autocallable Income ETF, is covered by the SIPC as a registered security. Now, given how important the classification is, here's what the SIPC generally does not consider as securities: currency, or any commodity or related contract, or futures contract, or any warrant or right to subscribe to or purchase or sell any of the foregoing. All the major brokers that we've talked about on this channel, such as Fidelity, Schwab, Vanguard, E-Trade, and Merrill Edge, are all SIPC member firms. In fact, the vast majority of brokerage firms in the US are SIPC member firms, with a few exceptions. One of these exceptions is if the SIPC deems that a brokerage firm's principal business, taking into account business of affiliated entities, is conducted outside the United States and its territories and possessions. Most brokers will list their SIPC membership on their website and or branch. But if you want to double check whether your broker is an SIPC member firm, just go to this list of members page on the SIPC website and click on the letter that your brokerage firm starts with to begin your search. So, now that you know what SIPC covers, what it doesn't cover, and how much, let's move on now to the next section of today's video. What if you have multiple accounts with the same brokerage company? This Investors with Multiple Accounts page, again linked below in the first pinned comment, gives a detailed explanation of how SIPC coverage works if you have multiple accounts with the same brokerage company. SIPC protection of customers with multiple accounts is determined by separate capacity, and each separate capacity is protected for securities and cash. $500,000 overall, including a $250,000 limit for cash only. Accounts held in the same capacity are combined for the purposes of the SIPC protection limit. And examples of separate capacities are listed down here and include an individual account, a joint account, an account for a corporation, an account for a trust created under state law, an individual retirement account, a Roth individual retirement account, an account held by an executor for an estate, and an account held by a guardian for a ward or minor. Let's walk through what this actually means for you and me with this illustration on how to calculate my maximum SIPC coverage. And let's say that I have an individual brokerage account in my name with the made-up firm High Yield Brokerage from earlier in this video. This individual account would have a maximum SIPC coverage limit of $500,000, including a maximum sublimit for cash of $250,000. If I then opened a traditional IRA in my name with High Yield Brokerage, this traditional IRA would also have a maximum SIPC coverage limit of $500,000, including a maximum sublimit for cash of $250,000, for a total SIPC coverage at High Yield Brokerage of $1 million, including a maximum sublimit for cash of $500,000. And if I then opened a Roth IRA in my name with High Yield Brokerage, this Roth IRA would also have a maximum SIPC coverage limit of $500,000, including a maximum sublimit for cash of $250,000, for a total SIPC coverage at High Yield Brokerage of $1.5 million, including a maximum sublimit for cash of $750,000. The reason for this is because the SIPC considers all three accounts as separate capacities. And if I'm so flush with cash, I'm not, but if I were, and I then opened a joint brokerage account with Marcus, so in both our names, this joint brokerage account with Marcus would also have a maximum SIPC coverage limit of $500,000, including a maximum sublimit for cash of $250,000, for a total SIPC coverage at high yield brokerage of $2 million, including a maximum sublimit for cash of $1 million. Because again, the SIPC considers a joint account as separate capacity from these other three accounts in my name only. Do note that even though this is a joint account with both my name and Marcus's name on it, this does not mean that my SIPC coverage is doubled, unlike with FDIC insurance. Now, if instead of opening a joint brokerage account with Marcus in both our names, I opened a second individual brokerage account in my name alone, like this one up here, both of these individual brokerage accounts in my name would be combined, and I would still only be covered by SIPC up to a total of $500,000 across the both of them. Also keep in mind that these are just examples of the accounts I hold with this made-up high-yield brokerage company. If I won the jackpot and used that money to open up the same 4 accounts with Fidelity, I'd basically be doubling my SIPC coverage. If you want additional information on how this works, you can click on this link here from the SIPC's Investors with Multiple Accounts page that I referenced earlier. So, now that you know how SIPC protection works across multiple accounts, let's keep going to the next section of today's video. How does excess SIPC coverage work? Excess SIPC insurance is designed to cover you up to a certain amount in the event that the security holdings and cash in your brokerage and or retirement accounts exceed the SIPC's coverage limit at an SIPC member firm, meaning this excess coverage would only be used as an insurance on top when the SIPC coverage is exhausted. Excess SIPC insurance is provided by a private insurer, not by the SIPC, and as I understand, is typically purchased at the discretion of the brokerage company. There's no legal obligation to provide excess SIPC insurance, although most major brokers do so. Let's take Fidelity as our first example. The total aggregate excess of SIPC coverage available through Fidelity's excess of SIPC policy is $1 billion. Within Fidelity's excess of SIPC coverage, there is no per customer dollar limit on coverage of securities, but there is a per customer limit of $1.9 million on coverage of cash awaiting investment. This is the maximum excess of SIPC protection currently available in the brokerage industry. So $1 billion can be a lot if it's for a few isolated cases only, but it clearly would not be sufficient if a brokerage collapsed completely and all the securities and cash were gone. That said, in the history of the SIPC, less than 1% of claims filed were greater than the limits of SIPC protection. If you want more details on this, I've attached the SIPC's latest annual report in the description below. And if we look at Schwab, the combined total of Schwab's SIPC coverage and excess SIPC coverage means Schwab provides protection up to an aggregate of $600 million, limited to a combined return of $150 million per customer, up to $1.15 million of which may be in cash. This protection becomes available in the event SIPC limits are exhausted. At Merrill Edge, coverage above SIPC limits is covered by Lloyd's of London. Customers who have exceeded the full SIPC limits have further protection provided by the Lloyd's policy, subject to an aggregate loss limit of $1 billion for all customer claims and includes up to $1.9 million cash per customer, excluding any FDIC eligible products within the account. For those of you with E-Trade, your assets are safeguarded under their ultimate parent company, Morgan Stanley, which maintains additional insurance with an aggregate firm-wide cap of $1 billion for securities and a $1.9 million per client limit for uninvested cash. If you're with Robinhood, their website states that they've purchased an additional insurance policy for Robinhood Markets Inc., Robinhood Financial LLC, and Robinhood Securities LLC to supplement SIPC protection. The additional insurance becomes available to customers in the event that SIP limits are exhausted. This additional insurance policy provides protection for securities and cash up to an aggregate of $1 billion and is limited to a combined return to any customer of $50 million in securities and $1.9 million in cash. For our Wealthfront fans, do note that in addition to baseline SIPC coverage, Wealthfront also carries private excess SIP insurance with an additional $500 million in aggregate and a maximum of $900,000 limit on cash per customer. As for Vanguard, they don't disclose too much detail online, except that securities held in your Vanguard brokerage account are held in custody by VBS, and that VBS maintains additional coverage through an insurer that supplements SIPC coverage. When we called them last year, though, the Vanguard representative we spoke to told us that Vanguard has a total aggregate excess SIPC coverage of $250 million, and that there is a per-client limit of $49.5 million for missing securities and $1.9 million for missing cash. If you would like more detail, I would suggest reaching out to them directly to confirm if anything has changed in recent months. Now, I think that what we can see is that it appears that the average customer at one of these leading brokerage companies is pretty much covered when you combine the SIPC's coverage limit with the excess SIPC coverage limits. So hopefully this will give you some peace of mind. All right, Diamond NestEgg members, Super Savers, and course fans, I hope you enjoyed today's video and learned something new. And as always, if you want to learn more about bond investing and building out a bond portfolio while rates are still attractive, then check out this video here on our bond courses, because rates haven't been at these high levels on average in decades. And for those of you who subscribe to Your Financial Journey, check out this latest video here from Caitlin on the 15 wealthiest suburbs in America. Do you live in one of them? I've linked all the details on Caitlin's video, our bond courses, and our YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.